Warren Buffett doesn't invest in exciting, trendy companies. He prefers boring ones, and that's made him over $100 billion. But why? Because boring companies often do something simple, and they do it extremely well. They have steady profits, loyal customers, and most importantly, they're predictable. Take Coca-Cola, for example. Buffett bought his first shares in 1988, spending $1.3 billion. The company sells sugar water. Nothing fancy, but it has global reach, pricing power, and consistent demand. Today, those same shares are worth over $25 billion, and Berkshire collects $736 million in dividends every year. Another example, American Express. Credit cards, loyalty programs, travel services. Not exactly exciting, right? But Buffett has held Amex stock for decades, and it's paid off massively, both in stock growth and annual dividend income. Now, you might be wondering, why do these companies keep paying Buffett's Berkshire Hathaway $736 million a year in dividends? Well, because they make a lot of money. In the last 5 years, Coca-Cola's net income is over $82 billion. It's a huge amount, but what's even more impressive is their return on equity. That's a measure of how much profit a company makes for every dollar of shareholder equity. Coca-Cola has a 5-year average of 71%. That means for every $1 of shareholder money, they generate $71 in profit. How do they do it? Well, they've got a strong competitive position in the market. They can raise prices without losing customers. They've got a loyal customer base and strong brand, and they're constantly generating cash. Free cash flow is basically the cash a company generates after paying for everything it needs to stay in business. Coca-Cola's free cash flow in the last 12 months was $10 billion. It's a lot. And here's what's really interesting. If you look at the stock price, it's pretty much the same as when Buffett bought it 35 years ago, but the dividends are way higher. Back in 1988, Coca-Cola paid a dividend of $1.25 per share. Today, it's $1.76. That's an increase of 40%. Now, this isn't typical. Most companies don't pay out 40% more than they did 35 years ago. But what's amazing about Coca-Cola is that they've increased their dividend for 61 straight years. That's an incredible track record. It shows you the power of compounding. When you reinvest your earnings back into the business, you can grow faster. And if you do it for decades, the results can be amazing. Buffett knows this. That's why he loves Coke. He's not buying an exciting stock. He's buying a great business. He's buying a boring stock that does one thing really well. Buffett once said, "I try to invest in businesses so good that even an idiot could run them, because someday one will." That's the point. Buffett wants companies with durable competitive advantages, strong brands, reliable earnings, and products people use daily. To most investors, these companies seem boring. But to Buffett, boring means safe, profitable, and long-term wealth. So next time you're looking at stocks, remember this. The flashiest company might not be the best investment. Sometimes boring is beautiful. Subscribe to my channel for more timeless investing lessons from Warren Buffett.